In this video, we are going to share with you our 2022 Stock Market Investing Beginner's Guide. If you or someone you know is hoping to start investing in the stock market so that you can get a piece of that financially delicious stock market pie and rake in profits that'll help you deal with inflation and unexpected expenses, then you've come to the right place, because by the end of this video, you're going to immerse yourself in the basics of investing in the stock market and get started with confidence. Welcome back, Money Masters. It's another Wealthy Wednesday, where we open the kimono and reveal the secrets that the wealthy elite have been using for decades to generate massive amounts of passive income through entrepreneurship and investing. As we mentioned earlier, today we are going to be talking about our 2022 Stock Market Investing Beginner's Guide, which will help you immerse yourself in the basics of investing in the stock market and get started with confidence. But before we dive in, I just want to let you know that on Friday, we will be discussing credit cards for beginners in 2022. So if you don't want to risk missing out on that episode, make sure to subscribe to our channel and hit the bell icon so that you can be notified of our next amazing video. Okay, with all that said, if you are like us and are totally committed to obtaining financial independence, then go ahead and tap that like button and let's get into it. To start, let's have a brief recap of what stocks are. Investopedia explains that stocks, aka equities, are securities that basically allow you to own a fraction of the company you're buying stocks from. Each unit of a stock is called a share, with each share entitling the shareholder to a portion of the assets the company has and profits it generates according to how many shares they have. The more shares of a company you have, the more you're entitled to. Most of the time, gains from the stock market are received by selling the stocks, but certain stocks also provide a steady stream of income, and we'll be discussing that later in the video. Step 1. Finding a stockbroker. The first step to getting your foot in the stock market is to find and sign up for a stockbroker. You don't have to worry about finding good stockbrokers nowadays, because there are a whole bunch of them just waiting for you to sign up. Some of the best stockbrokers for beginners include low-fee stockbrokers like Robinhood and Webull that allow you to buy and sell stocks for free. If you've got a bit of capital and you're looking for more established brokers, then you might want to take a look at brokers like Interactive Brokers, Fidelity Investments, TD Ameritrade, and Ally Invest. Either way, signing up and getting your account set up is simple and straightforward, especially if you're living in the USA. Just head on over to their respective websites, fill out the registration forms, and just like that, you're pretty much ready to start buying and selling stocks. If you guys have any suggestions for introductory stockbrokers, let us know in the comments down below. Step 2. Pick an investment style. Now that you've made an account at your preferred stockbroker, this would be the best time for you to decide the investment styles that you're going to take up when investing, given your current funds and your risk appetite. Investing style number 1. Passive investing via index funds. Our first investment style is passive investing, which is quite possibly the least involved investment style of all 4 styles we're discussing right now. The concept of passive investing through index funds is that you basically pick and choose between different index funds, which are groups of stocks that are made to track specific groups of the stock market. The main benefit of passive investing is that it doesn't require as much research and investigation into the finances of specific companies, and on average will be a good investment years down the line. Examples of popular index funds include the Standard & Poor's 500 or S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite, and the Russell 2000. Investing style number 2. Growth investing. Next up is the investing style that involves putting your eggs into the baskets of companies that might be considered disruptive. These disruptive companies are the kind that might disrupt the status quo of their respective industries via innovation, possibly even within the next 5 to 10 years. For example, companies under certain tech industries might flourish in the coming years. These may include automation and self-driving cars, artificial intelligence, and even blockchain companies, since these are the kinds of industries that might cause major technological or otherwise status quo threatening developments in several industries. The same way Netflix and other online streaming services had a major disruptive effect on the video rental and possibly even the theater industries. One of the major metrics to take note of is revenue, because even if certain companies are considered disruptive, it doesn't automatically guarantee that they'll be profitable. Another metric to look at is the equity of a company, since this gives us an inkling of how good the company is in generating returns on the investment you'll make by purchasing units of their stocks. Now, we know that investing into disruptive companies can be a touchy subject, so we'd like to know your thoughts about the topic. Do you agree with our thoughts on it? Let us know in the comments below. We'd love to start a discussion. Investing style number 3, dividend investing. Our next investing style to be discussed is dividend investing, which involves a bit of research into and investing in stocks that pay dividends. This is the kind of investing that is pretty much guaranteed to provide some passive income in the form of quarterly or monthly dividends from these stocks, as long as you play it smart and choose good dividend stocks to invest in. When choosing between dividend stocks, there are a few criteria that you'll want to look at in particular to this style of investing. The dividend itself, including the dividend yield, the payout ratio, which is how much of the companies are allocated towards paying out dividends, a company's past earnings, and lastly, their dividend history, which indicates how well they've gotten about paying out the dividends to their shareholders. As a rule of thumb, you'll want your dividend to yield to be as high as possible, with the payout ratio more on the lower side, as companies that have rapid growth prefer to allocate lower proportions of their earnings towards dividends, with companies with substantial cash flows tend to grow their company slowly, instead allocating most of their earnings to paying shareholders. You'll also want to pick companies that have been earning more recently and have been able to pay their shareholders consistently, showing a degree of trustworthiness regarding dividends. Investing style number 4, value investing. Our last investing style is value investing, which is a style that pretty much involves buying companies at prices that are lower than their intrinsic value. This is the investing style that made Warren Buffett, chairman and CEO of Berkshire Hathaway, as rich he is today. We aren't saying that you'll immediately become extremely rich thanks to this, but doing this right can have its major returns. In a sense, it's buying low and selling high, with emphasis on knowing what a company's worth and comparing their value to their current price, essentially figuring out whether you're getting a bargain out of this or not. One way of doing so is to look for stocks that have low PE ratios, price to earnings ratios. Having a low PE ratio means that the price of that particular stock is comparatively low in relation to the earnings of this company. This is good because the low price is a good deal, since the past earnings may be an indicator of this company's growth and the ballooning of the stock's price years down the line. On the other hand, if the PE ratio is high, you might want to keep that in mind, as the price of the company is comparatively high in relation to its earnings, meaning that it might not be a good investment. This isn't the end-all be-all method of calculating intrinsic value. However, it's a good idea to look it up and study how to calculate it. Now that you're familiar with the different investing styles, don't be afraid to try each of them out and find the one that fits you the most. Also, don't hesitate to take what you've learned from each style and make your own mix and match style of investing. Combining styles can help you diversify your portfolio and gain benefits from nearly all circumstances. If any of you or someone you know has earned a lot from investing thanks to this guide, be sure to share about it in the comments down below. We'd love to hear all about it. Step number 3. Seriously, start investing. The last step is to actually start investing. Take the leap. Don't worry. You don't even need to start with large sums of money. A lot of good stocks nowadays go for as low as $10, so you can experiment and figure out what you think is the best style for you, and the earlier you start, the better your investment returns will be down the line. Now, you may also be wondering about what you should do if things get rough and the economy or specific stocks go down in price. In those cases, don't panic. In general, it's a good idea to calm yourself and take a good look at the big picture. In economic downturns, the prices of stocks will go down. That's bad for the stocks you're holding right now, but the economy always bounces back, so don't worry. In fact, given that it will always bounce back, it's a good idea to purchase some of those stocks you've been looking to add to your portfolio, since their prices are cheaper now. So remember, don't panic and good luck investing. How did you find our investing steps in this video? If you have any suggestions or feedback, leave a comment down below. And that's all the steps and tips from our 2022 stock market investing beginner's guide that we have for you in this video. We hope you learned some very helpful insights from what we've shared with you today. Please don't forget to leave a like on our video if it was able to help inform and positively influence your financial decisions and lifestyle. And leave a comment down below about how you feel like this video will help you boost your overall income. Also, if you love our content, subscribe for more Money Masters content and updates so that you don't miss out on our next episode of Finance Friday, where we will be discussing credit cards for beginners in 2022. Lastly, we'd like you to consider sharing this video with at least one friend. It would mean the world to us if you would join us in our mission of helping good people like you keep more of what they earn and earn more from what you keep. That'll be all from us in this video, Money Masters. We'll see you in the next video.